Today, I'm breaking down the 5 best Vanguard ETFs to buy and hold forever. Funds that can realistically help you build a 7-figure portfolio and move closer to financial independence. Stay with me until the end because I'll also reveal one Vanguard ETF you should avoid completely, since holding it could really drag down your long-term returns. The key here is going to be patience. The stock market can be unpredictable in the short term, but history shows that over time, disciplined investors who stay the course dramatically increase their chances of doubling, tripling, or even quadrupling their wealth. My name is Chris, and if you're someone who wants to take control of your finances and build wealth step by step, you're in the right place. Make sure to smash that like button and subscribe. It really helps the channel reach more people who want financial independence just like you and me. If there's one ETF every US investor should consider, it's the Vanguard Total Stock Market ETF. Ticker symbol is VTI. This fund gives you exposure to the entire US stock market, large companies like Apple and Microsoft, mid-sized firms, and even smaller growth companies. In total, it holds over 4,000 different stocks. Why does that matter? Because instead of betting on a single industry or company, you're buying a slice of the entire American economy. If US businesses continue to grow, so does your portfolio. Performance has been strong. Over the past decade, VTI delivered an average annual return of around 11 to 12%. To put that in perspective, a $10,000 investment 10 years ago would now be worth over $30,000. Of course, it's not always smooth sailing. During the 2008 financial crisis, VTI dropped by about 50% and took several years to recover. But long-term investors who held on and even added more capital during the dips were definitely rewarded. Costs for this ETF are nearly zero. The expense ratio is just 0.03%. That's 30 cents a year for every $1,000 invested. If you want one fund that could form the core of your portfolio, VTI is a great place to start. But if you want to reduce concentration in tech and mega caps, you'll need to pair it with other ETFs we'll discuss later. Up next, let's cover a fund that gives you exposure to a completely different asset class, real estate. The Vanguard Real Estate ETF, ticker is VNQ, focuses entirely on US real estate investment trusts or REITs. REITs are companies that own and manage properties like office buildings, warehouses, apartments, and shopping centers. When you invest in VNQ, you get indirect ownership of hundreds of properties across the country. The advantage is you don't have to manage the tenants, deal with repairs, or save for down payments. Historically, real estate has provided 2 types of returns: price appreciation and dividend income. VNQ currently yields about 3 to 4% annually in dividends, which can be reinvested for compounding growth. Over the last 10 years, VNQ has returned around 7 to 8% per year on average. That's less than VTI, but the dividend income makes it attractive for diversification. The trade-off is volatility. During the 2008 housing crash, VNQ fell more than 65% and took years to recover. So that's a good reminder that real estate isn't immune to downturns. But for long-term investors, adding real estate can balance out a portfolio that's otherwise heavy in technology and consumer stocks. Now, what if you want exposure to the next wave of small, fast-growing companies? That's where the Vanguard Small-Cap ETF comes in. The Vanguard Small-Cap ETF, ticker is VB. It invests in smaller US companies, generally those with market values between a few $100 million and a couple $1 billion. Why does this matter? Smaller companies often grow faster than established giants. They're riskier, but historically, small cap stocks have delivered higher returns over the long run. VB holds over 1,500 stocks, spreading your money broadly across industries. And here's a key difference. The top 10 holdings make up less than 5% of the fund. That means no single company dominates performance. Over the past decade, VB returned roughly 9 to 10% annually. That's slightly lower than large cap stocks in recent years because mega companies like Apple and Amazon had extraordinary growth, but over long periods, small caps have often outperformed. The risk here is higher. VB has a risk rating of 5 out of 5 from Vanguard, and during market crashes, it can drop more than 50%. But if you have a long time horizon, adding small caps can balance out a portfolio that's too focused on the biggest companies. Now, maybe you're less interested in small caps and more focused on established giants that are still growing fast. That's where the Vanguard Growth ETF comes in. The Vanguard Growth ETF, ticker symbol is VUG, invests in large US companies that are expanding faster than average. These are firms with strong revenue growth, solid balance sheets, and high demand for their products. Think of companies like Apple, Microsoft, Amazon, and Google. In fact, technology makes up about 40% of this ETF. That concentration can be risky, but it's it's also been a major driver for growth. Performance has been impressive. Over the past decade, VUG has averaged returns of above 13% per year, so a $10,000 investment 10 years ago would now be worth more than $34,000. The expense ratio is just 0.04%, keeping costs low. So what's the downside? Growth stocks can be sensitive to interest rates. When borrowing costs rise, investors sometimes shift away from high growth companies, and funds like VUG can experience sharp declines. In 2022, for example, VUG fell more than 30% when rates jumped. For investors who want concentrated exposure to high growth US companies, VUG is a strong option. But if you already own VTI or an S&P 500 ETF, remember that you're getting some overlap here. We've talked about US funds so far, but what about the rest of the world? That's where the next ETF comes in. The Vanguard Total International Stock ETF. The ticker symbol is VXUS. It provides exposure to companies outside the United States. It holds nearly 8,000 stocks from developed markets like Europe and Japan, as well as emerging markets like China, India, and Brazil. So why does this matter? While the US dominates global markets, international exposure helps diversify against the risk of relying too heavily on one country. Over the past decade, international stocks have outperformed US stocks, returning around 4 to 6% annually. But history shows the leadership rotates. There were long stretches when international markets outperformed the US. VXUS has a low expense ratio of 0.07%. It also pays dividends, typically around 2 to 3% annually. The biggest risk is currency and political instability. International markets can be volatile, and investors should expect more ups and downs compared to US-only funds. For long-term investors, allocating 10 to 20% of a portfolio to international stocks through VXUS can provide true global diversification. Now that we've covered 5 strong ETFs, let's talk about one Vanguard fund that I would avoid. At first glance, the Vanguard Total World ETF, ticker symbol is VT, seems perfect, right? It combines US and international stocks in one single fund. About 60% in US and 40% in international. So why avoid it? The problem is the weighting. 40% in international stocks is far higher than what most investors might want, especially considering how much the US has outperformed over the last decade. Instead of forcing a nearly 60-40 split, it's often better to hold VTI for US exposure and add VXUS in whatever proportion you prefer. This way, you control how much of your portfolio goes into international markets. For example, you might choose an 80% US and 20% international split, which is much closer to how global investors allocate today. So while VT sounds convenient, it limits flexibility and over allocates to markets that have lagged behind in the past. So quick recap here. If you want broad US exposure, VTI can be your foundation. If you want real estate without managing property, VNQ adds that layer. For faster growth and more risk, VB gives you small caps. For concentrated large cap growth, VUG is definitely the play. For international diversification, VXUS covers the globe outside the US. And the one to avoid is VT, because it locks you into an allocation that may not fit your strategy. The beauty of these ETFs is that they're simple, they're low cost, they're easy to hold for decades, and you don't have to outsmart the market. You just need to stay invested and add consistently. Do you currently own any of these ETFs in your portfolio? Drop your answer in the comments. I'd love to see how many people are already allocating to some of these funds. And do you think US stocks will continue to outperform over the next 20 years? Or is it time for international markets to take the lead? Your perspective could definitely help myself and someone else trying to refine their strategy. And remember, I'm not a financial or tax advisor. This content is for educational purposes only. Always do your own research before investing your hard-earned money. If you got value from this video, make sure to hit the like button, subscribe, and share it with someone who wants to start building wealth through ETFs. My name is Chris. As always, thanks so much for watching, and I'll see you guys in the next one.